Hello, welcome to McBoss Capital channel. My name is Michael Chu. You can reach me at this email here. And today we're going to talk about what happened since Russia invades Ukraine. Quick disclaimer here: all materials shown are for informational purpose only. They are not investment recommendations, and I'm not a registered investment professional. Today we continue to focus on sharpening our skills. What are we looking at when to buy as in terms of the general market direction, as well as what to buy in terms of industry, sectors, and stocks. Today our analysis will include what happened since we last posted our last video 5 weeks ago. Obviously Russia has invaded Ukraine and WTI price has peaked recently, at least in the near short term. Also, we have a Federal Reserve announced the first interest rate hike and possibly 6 other hikes. And we'll look at existing market conditions based on analysis on McBossCapital.com. And we'll also talk about what does it look like when the market has bottomed in the previous 2 corrections. And then what to look for in coming weeks. And we are seeing broad-based rally right now. And where should you focus in terms of sectors performance since the lows? Hi, here is the Nasdaq daily chart. Sorry for all the markups here, but I like to go over some of the fundamental news that happened recently. So last time we took a break. The last time we posted a video was around here, and it was President's Day on February 21st. And at that moment we were hoping that it could bounce soon. And we did kind of mention that it's possible, if there was a war, that it could probably break down for a couple of days and then bounce back, and it did that. It actually surprising to the world, Russia invade Ukraine. So on February 22nd, Russia announced 2 regions of Ukraine as independent. And then on 23rd, we see that the market actually dropped to a new low, and thus confirming market in correction. And on 24th, which is this big blue, blue day, it was very similar to the January 24th low here. It closed, it was the day Russia invaded Ukraine, and the market panicked as usual, and it did recover and close higher that day, which was a good sign, at least near term. And it did bounce from there, but we found resistance at the 21-day moving average right here. And then it took another tumble as the war goes on, and obviously there was more bad news on there was a lot of sanctions. The oil price continued to move upward, which we'll talk about in a second, and then and market continued to come back down. There was a nuclear plan that the Russian siege, and there was fire, and it really scared the market and stuff like that. And as the war continued, things didn't go as well in the market. And stocks continue to correct in most areas. So during this time, a lot of stocks went down. Obviously, one area that actually did pretty well was commodities and energy sector, which are related to the war because of possible lack of supply and from Ukraine, and also sanctions from Russia. So I just took out the markups for a second just so that it's more easier to read the chart. So this week we actually had a really bad Monday, and we did undercut this low here. So one of the things I observed during that day when it undercut it was there wasn't much panic in terms of selling. For example, if a lot of traders were to set their stop loss at this level, we could have seen a much bigger drop here. but we didn't see that. So that was despite it was a down day that day, even though it closed pretty bad on that day, the fact that it didn't undercut this low by too much, and that there wasn't, like I said, a panic selling in terms of especially when it hit this low, right? Obviously there was lots of selling that day, but when it hit the low, I did not see huge panic. And that was a good sign, despite, like I said, it closed down the day, and we saw that, and it bounced the next day. And Wednesday, obviously there's a lot of traders or even, you know, long-term investors who are just waiting to hear what the Fed has to say, and when they, you know, announced that they raised interest rate for the first time, that was expected, but more, you know, people just want to understand better, like, what are their forecasts of rate hikes going forward. And what happened that day was quite remarkable. You know, let me jump to the 5-minute chart on that day, and we're gonna see here March 16, and you know, it went up in the morning, continue on Tuesday's rebound. But what happened was, before the Fed speak, it just started to slide down. And as soon as the Fed speak or announce that they're going to raise 6 times more this year, we saw a big, you know, really fast drop here, almost giving up all the gains for that day. But then the question was asked about how do you see the recession risk, and the Fed answered that it is very minimal due to, you know, strong demand still in the marketplace. So that is that propels this market to move higher and also close really strong, right here. You can see that, and then we follow through again. So this is what, you know, probably you know, for long-term investors, this is a really good sign on what happened here. And then we saw that continue on Thursday and Friday, where, you know, now the longer term investors are starting to come in and just continue to buy into the market. So we do hope this trend will continue. So let me jump back to the daily chart for a second here. So that's what happened here on Wednesday, and we see the fall through Thursday and Friday. Now, you know, we are at the 50-day moving averages, so that's the you know, the potential you know, peak here, right? Because, you know, there's a slight chance of that, right? Because, you know, that could act as resistance. Now, but we'll talk a little bit more about what we could potentially see here that could happen based on previous precedents of market correction. We'll look at S&P. This S&P actually didn't break to a new low here. You can see that, and that's a really good sign. And it rebound, and now it's, you know, because 50-day, the red line, and the 200-day are very close to each other. You can see now it bounced, you know, not only above the short-term moving averages, but also, you know, now it's near the long-term moving averages. So you know, obviously, if we do see that break above this level here, that is really good sign for the rally, right? Here's Dow Jones, very similar chart to S&P. It did, you know, rise above the 50-day, and same thing, it's just short of the 200 days moving average, which is the long term. So again, if it breaks above, we could see the rally continue very strong. So for Russell 2000, obviously it was one of the weakest index, you know, during the market correction. Again, we saw January 24th low, February 24th low, and it didn't make a new low here, which is very good sign. Obviously, it's much further down than its the long-term moving average here. So there's still a lot of room to recover. So if the market continues to rally, I could see that the Russell 2000 move a lot faster than the other indexes, just because it's so far above the 200-day that it's going to try to catch up. And you know, again, you know, it's hard to say whether, because Russell 2000 represents small caps, and there's a lot of talk about stagflation here happening, just because there's higher inflation and slower economic growth. So it's hard to say, you know, whether both of those are going to be true, right? No one knows until probably closer to, in 3 to 6 months from now, to see where inflation stands. Whether you know, by that time Fed would have, you know, raised interest rates quite a few times and possibly a lot. We don't know how much they will raise, whether it's just a quarter point or 50 basis points. So that could, you know, have an impact on the economy. So it's really hard to say whether there's stagflation at this point in time. And then, you know, we'll be looking at earnings result in the next, you know, definitely for the first quarter of this year and as well as the second quarter, to determine whether companies are reporting slower growth, or whether they're actually doing well, right? But the market, like I said, has reacted to the fact that the Fed Powell has said that the risk to recession is minimal. But but then the question is, like, how's the growth look like, right? So it's really hard to say with all the war still going on and sanctions happening and stuff like that. So that will impact trade as well. So in the last video, we just look at quickly the precedent of the last time when Russia invaded Crimea, and what happened was we saw the oil jump. I believe it was about like 5 days since the first day of the invasion, and then it peaked, right? Here you can see here Russia invade Ukraine here on February 24th, right? And if you count, right, initially it reacted and then it actually went back down, but then by the third day it started to move. Okay, so which is kind of interesting here. There was a fake move here, and then it really moved, right? So in about like 2, 3, 4, 5, 6, 7, 8 sessions, it went up a lot in terms of oil price, and it peaked at $123, right? And then on that day, it peaked, and then now it's starting to fall back down really hard, even below, which is interesting, even below the 21 days moving average. So this would shake in a lot of people. Now, now it has climbed back above this 10-day moving average right here. So, it is possible that, if the war continues, that will continue to impact oil, and that this could, continue to run as well. So it just does take some time, and I believe that's the same thing happened in Crimea. It was like it took about a few weeks after the first initial peak, which was 5 days from the day of the invasion, and then it moves up to even higher prices, right? So it is potential that now it's starting to set up for higher prices, say by the summertime, because oil tends to rally to the summer times when the most usage, consumer usage peak. So something to watch for, because obviously a lot of oil and gas and even general commodity type of stocks have run a lot in this like really short time frame. Next, we'll go to our website, www.mcbosscapital.com, and we'll find the market picture article here. And the title here is the stock market closed strong this week despite the first rate hike. What happened? We mentioned we did make a new low on Monday. It rebounded 4 days in a row to close the week with significant gains. You can see those gains here. Is probably one of the best weeks since 2000, I believe. So Nasdaq 8%, S&P 6%, Dow Jones 5%, and Russell 5%. On Wednesday, the Federal Reserve announced the first rate hike of 25 basis points and possible another 6 rate hikes this year. Basically, every single meeting they'll be raising. The question remains whether they will accelerate, how much they're going to raise in terms of whether it's quarter point or 50 basis points. I believe there's two Fed committee members who are vouching for 50 basis point in May. So that's something to watch out for. Potentially have a pullback in the market by that time. But the good news is they mentioned the recession risk is low and economy is strong right now. So market did bounce to close on Wednesday very strong. In terms of moving averages, we are seeing, as we saw on the chart earlier, we are seeing really strong movement, right? They all move above the 10-21 days moving average, which is really key. And then some of them are near the 50 days moving averages, and S&P and Dow Jones are above it, but they're trying to come to the 200 days moving average. And Russell 2000 is also above all these moving averages here, and again it's farther away from the 200-day moving average. It has regained some of the psychological level, like Nasdaq is now above 13,000, S&P above 4,400, Dow Jones now above 34,000, and Russell is now above 2,000. So probably the biggest sign of market improvement is stock market breadth, as we talk about in detail on how we analyze the market breadth in this course that we have. We saw 666 stocks being accumulated and 45 distributed this week. By the end of the week, and we see 117 industry groups under accumulation versus 7. So this is very broad type of accumulation, which is always a good sign for the market, especially at the now that we are near past the bottom. Just because we don't want to feel that this market rally is just a fake move, right? With so much accumulation, investors, especially long-term investors, don't come in to buy for short-term. So most likely they'll be holding on and probably adding more to their position over the coming weeks. So that's the sign of strength right now. And there's lots of accumulation in all types of industry groups, right? From technology areas, you can come to this website and just view the stocks that are being under accumulation right now. There's just a lot of stocks that are showing signs, technology, retail groups. So we'll talk about the sectors and performance in a second here. Industrial, health related stocks. Just, probably the one I want to highlight here was there's the all the pharmaceutical stocks, really strong. 40 stocks are under accumulation right now, which is probably haven't seen that in such a long time. Healthcare, so healthcare stocks, doing well. And then we have some commodities, but you can see, there's not many stocks in those groups that are doing well. So they might come back up after that recent pullback, which is a very strong pullback. And then we see financial also picking up, at least for now, it looks good.
Market data connection lost.
And then here at the bottom, we just show some of the stocks that are being distributed. So, there's not too many, but again, compared to the number of stocks being accumulated. So we just want to look at the higher level market and look at the index and the sectors in terms of their performance. So we charted here since that from Monday close to Friday. So four sessions here we're looking at. So since the market bottom, I just want to chart, which sector and which area is showing the best performance, right? So if this market will continue rally, and this trend, what we have right now based on 4 sessions continue, where is the strongest performance that you want to focus on? And so right now you can see Nasdaq had a 10% gain since Monday close, which was the low, right? And so Nasdaq, which comprise a lot of growth stocks, so technology stocks and a lot of growth stocks are doing really well. Just to say there's one area that shows significant strength was Chinese stocks, right? Because of some potential agreement between China and US about regulatory requirements in terms of listing in the US exchange. And many of those stocks jump, lots. I think, some even jumped 30% on that day on the announcement. So it was quite significant. And obviously, US stocks as well are doing really well in the growth area. So that is the strongest performance in terms of the indices. We see that Russell, which is the small cap, came in second, 7%. Again, we talked about it just now, that there is a lot of talk about stagflation. If that is true, small caps generally has less impact from a macro perspective, and they can still grow within a stagflation environment. So, we want to watch that, right? We want to watch that whether in a month or two from now, whether Russell 2000 will lead the market in terms of, and that's a sign of stagflation if that's happening. We see S&P coming in third place, 6%, and Dow Jones at 5%. So, S&P represent the broader market, and Dow Jones represent generally the large cap global stocks. And you can see it underperform compared to the other indices. So this is just to understand which kind of stocks and what area you should focus on. On the spider sectors, there's 12 here that I listed, and you can see technology doing pretty well, 9%, right? Communication 7%, but the highlight here is probably the consumer discretionary and the retail area. Both are near 10%, which is really outperformance, and that could be related to as well as the reopening of the economy, with people traveling and spending money on services area and stuff. So and even goods, right? So that's really good. And consumer stable, you can see, is probably very weak performance right now. Then we have the industrial and materials, 4 to 5% here, which is again kind of represent what S&P 500 performance look like. We have utilities definitely underperform. Healthcare at 5%. So this one is also mediocre, but we did see biotech stocks, which usually represent more in the growth area, doing really well. Then we have energy sector, which we saw from last video, and even recently until the recent peak, it actually outperformed every other areas since the beginning of the year. Then we have financial sector, again doing not bad, 5%. So again representing more on the S&P 500 level. And then we have real estate, REITs and stuff, which also not the best performance compared to the rest. So just something to be aware of, where the leadership may be coming from in coming weeks, if and even months, if this rally continues. So we're just gonna dial back to the two previous corrections. One happened in December 2018. And you can see this correction is also very steep, very fast, roughly about 3 months or less, actually. So just want to study what happens. And right now we can see we are at around this junction here, which is the 50 days moving average for Nasdaq. So so right here. And what we want to see, based on this precedent here, we see that it continued to move upward, and obviously there's some challenges here. And then within a week, there's more challenge. Here's another one. So it even undercut this level here. So that also probably shake out a lot of people who are a little bit still nervous about the market, right? But you can see it tested twice before it make more substantial move. And I think the key, the few things that to be more sensitive here and cautious about is we do recognize here that it did stay above the 50-day moving averages once it crossed it. So it never actually went below this red line. So that's very important to understand that this is what a rally looks like since the bottom right here, right? The other thing I'll just mention quickly here that it took a lot longer for it to move to the 50 days moving average, just because how steep this correction here is, right? So it took like, you know, more sessions here, because I think if we will look back at today's chart, we will see that it only took like four sessions to come back to the 50-day. It also showed that the market in today's market has been steeping down further in terms of the moving average, meaning it took a longer time than this correction here. So which is a good sign, because it means that, you know, it has, because, you know, for a correction, a lot of people ask, you know, how does it bottom, right? There's two things that could happen, three things actually. One is time, right? The longer the time period is, the more likely the market is going to bottom. And then there's price. The more it corrected, the more, you know, the higher chance of a bottom as well, right? And then the third thing is sentiment, and, you know, how many people actually give up on the market, you know, that they just don't want to buy into the market. So all those three things combined can put a bottom in the market, because the market is very psychological. And so now as it moves up, you know, people who are missing out on this bottom rally now starting to buy back in, and so that's what causes the market to continue to move up. So that's what happens. So, but anyhow, I just want to showcase like what happens as we are now where we're at right now. So we see these two tests here, and then it slowly move up. And so probably the other thing I want to mention here is very important, is that, you know, is this 21-day moving average. At least for Nasdaq, it's been a very crucial support line. So that's something we want to pay attention as well, right? And we did see this, you know, here cross back, but it did bounce back. So that was a small, quite a pullback here, but it did respect that line. The next correction we want to look at is from the pandemic lows, right? So that one was a very quick correction as well, and you can see, you know, it was just sloped all the way down, and then it took quite some time to bounce back, right? Because, you know, it just happened so fast, and the 50 days, you know, still much higher. So that's another difference between today's market as well. But here we see that it crossed, you know, again, the red line, which is the 50-day moving average, and we see that it bounced up, and then it tested once, right? And then the funny thing is exactly what happened in the last correction that we just saw. It also went back up, and then it comes back and tests the 50-day once more. And also not that it actually undercut the first test as well. So just to be aware, this could happen in this coming week or so in today's market, that we might see two tests, and where the second test is actually lower than the first test. So, but with that being said, what happened is we can see clearly here is still above the 21-day moving average. And also, so here it did undercut the 50-day. So that, again, that shakes out a lot of people that day, just because, you know, people get nervous that it's going to go back down. But what happened was, you know, and that's another thing, right? If it does in this scenario, it should bounce back very quick, and it did. So the next day, you know, it gaps up. You can see that right here. So those are the signs we're looking for if this market rally were to continue. So let me jump back to today's date here, just to follow up on what it looks like, right? And I'll just put away the markup just so we can focus on the chart here. So again, we're seeing this huge, you know, bounce here, and we're now hitting this 50-day. So what do we expect? We could expect it to move up slightly, and then come back down once, move up more, come back down even lower. So we could expect this, you know, just based on the two previous correction. That's exactly what happened, and it shakes out some people who are still, you know, weak in terms of, you know, they're very nervous that, you know, they're gonna shake them out, right? That, oh, you know, it bounced back, I better sell, you know, I better get out, you know, take my losses or whatever, and just, you know, recover some of these gains, right? But you know, so that's what we're looking for, and if it works out, it will rebound from here, right, and make a new high and continue to, you know, we will see a strong rally. So this is kind of the expectation I'm hoping for. Now, obviously, it could always, you know, break down, and, you know, and again, we need some, usually market doesn't break down hard for no reason. So unless there's some sort of macro news or something, that is unexpected, that we could see the market continue another leg down, right? So just something to be aware of. But again, I'm more hopeful right now, especially with the broad market rally that I've been showing you about. Alright, so right now we're going to look at some stocks. So on our website, on this article that we talked about earlier, we can see that major pharmaceuticals have one, it's one of the strongest group here. So we'll start with that. So here you go. We can look at the industry group in general, and we can see that it has now, this is a weekly chart, and you can see this week it has climbed back above the 50 days moving average. One of the stock we can look at is Moderna, and obviously it has a huge breakdown here, and now it's coming back above the 50-day moving average, the red line. One of the criteria I tend to look at is earnings and sales on the fundamental side, and you can see it's increasing its earnings as well as its revenue. Those are really good signs for this stock. Next group is Computer Software Enterprise. It is currently just at the 50 days moving average, so I'm not sure if we'll break through here, but just something to watch for. And one of the stocks that are actually doing pretty well even during this recent correction is GoDaddy. They are, increasing their earnings here as well as their sales here, so those are good signs. That's probably why it holds up pretty stable in terms of its earnings and sales. Here's Finance Investment Management Group, also just sitting at the 50-day moving averages. You can see this stock actually has climbed above the 50-day now, and it's also above the 200-day. Earnings and sales are pretty good as well, you can see there. Here's Semiconductor Equipment Group, just sitting at the 50 days. And here's the stock ACLS, doing really well. In fact, it broke to new high, really strong chart right here. It's now in the third stage base. Relative strength, you can see it hit new high because the stock hit new high, and earnings are climbing like 100% or more, which is remarkable, and the sales are increasing acceleration as well. So really strong stock. You can see this right here. Internet content, sitting at 50 days, just slightly above it. Bumble, one of the dating app, and obviously with the pandemic opening, like probably they will experience a surge in usage and stuff. It has climbed above the 50-day. It is not the strongest earnings, but it is still not making money yet, but at least the sales are increasing, so something to watch for. But you can see it's now in the single-digit loss, so whether they can turn in a profit is very important going forward. Retail restaurants, again, with the economy reopening, there's a strong sign that it could recover, and here you can see it's above the 50-day moving average. And here the stock is Darden Restaurant, which is a pretty big operation in terms of Olive Garden and many other restaurants. A little bit weak in terms of technical. It's still slightly below the 50-day, but earnings and sales, you can see, are starting to improve as well significantly. So here's Finance-CrdtCard Payment Group, and you can see it did rebound really strong from a big drop. I think a lot of stocks, which were surprising because many stocks in the group, including PayPal and so forth, are hammered during this recent correction. So it is recovering. This one is dLocal Limited, really strong earnings and sales, triple-digit gains here, and you can see it power through the 50-day right here. So very strong, both technical and fundamentals. Building construction, just slightly above 50-day. As you can see, many groups are now starting to try to come above the 50-day, which is where the index are as well. So very critical in the coming week or two to be able to hold on to this level and power through higher, right? So that's what we'll be expecting for this rally to continue. So in the stock level, we have builders for source, building a nice round base. You can see it has really strong technicals, like eight blue wicks here, while the market was correcting. Significant earnings and sales. As you can see, triple digit growth almost, right? And sales are very high as well. So we are seeing very strong performance here. So I believe there's one more here, finance property REIT, also climbing up slightly above 50-day. We have innovative industrial properties above 50-day. Earnings and sales are also growing, so very good. Thank you for watching this video. Give us thumbs up if you like it, and subscribe to our YouTube channel. And you can go to our website at www.macbosscapital.com or email me at this support email right here. We do provide educational and research service and provide one-on-one session if you need help on. Thank you for watching this.